Hello, this is Ahura with NFP updates from OTEX markets. First of all, let's see the NFP data, non-farm payrolls data that published so far a few minutes ago, and then we can check the market reaction as well. As you can see in economic calendar, the average earnings increased by 0.4% per month in May and 4.1% in the annual scale. Both of them, both of them were more than above the market expectations. But at the same time, there are some mixed data with the unemployment rate increasing to 4% from 3.9% in April. But at the same time, on the other hand, we can see that 272,000 newly created jobs, which is much higher than 182,000 that we had previous month. The mixed data, as I told, the mixed data, because we can see the number of the April decreased to 165,000 and unemployment rate increased to 4%. These data somehow can soft the positive reaction of 0.4% average earnings and 272,000 newly created jobs. So these data somehow they are positive, good for stock, they're somehow they're good news for the labor market. But the negative side of this data, there is these 4% unemployment rate and previous month review, which is the reviewed downside to 165,000 jobs. So, but generally, the market looking first of all to this number, 272,000 newly created job. Also looking at the average earnings. Why? Because higher earnings means that the people they will have more money. More money means the more spending, more demand, and higher inflation for longer. So these data means that the central bank can hold the higher rates for longer, which is reflecting directly on the market. As you can see, the market expectation of 55% rating cut in September meeting is now it's down to 50%. Before data published, more than 55% expectation we had for 25 BPS or basis point rate cut, but now it's fall to 50%, while we can see the 44% expectation for holding the rates at the current level, which is the 4.50%, while it was about 40% like yesterday. The 4% unemployment rate, which we have right now, is the lowest level, as you can see here, since January 2022. So the labor market, that number shows that the labor market has somehow the sign of easing or some of the weakening signal. It has like kind of the weakening signal. So the labor market has a mixed data, but still these mixed data mostly are positive. That's why the reaction, if we see the market reaction, we can see faster increasing of US dollar index. US dollar index increased much higher than like an hour ago. When before data published, we had the DXY around 104 point, and now it's around 105 mark. That can somehow help the US dollar index to hold its current rates around this level, between 105 and 104. But we cannot say that it can support US dollar index to increase much higher, as I told, because after 1 or 2 hours, the market will kind of adjust, and market will see the more detail for this. I mean, first of all, this market reaction can be emotional reaction. Wow, we had 272,000 newly created jobs. But after 1 or 2 hours, investors will understand that unemployment rate increased to 4%. So they should not be that much happy for newly created job. At the same time, we had the previous month's number revised down to 165,000 credit dropped from 170 some. So that means that the real condition of the labor market is not that positive that at the first glance that we can look at that. So data are positive, but not that much positive to suffer US dollar to increase much higher. About the stock market, if we look at the S&P 500 as the overall overall stock market, kind of like the general condition of the stock market, we can see that yes, these data means higher rates for longer, which means that the weaker which means the more pressure on the stock market. So yes, S&P 500 fell down to 5,230 from 5,260. But to see if it will continue further to fall more or not, I can say yes. Why? Because there is two scenarios. First of all, for the first scenario that yeah, we have a higher inflation, higher rates, stronger job market, so we can keep the higher rates for longer, which means the pressure on the stock markets. On the other hand, if we see the weaker number of the economic activity, which means that the U.S. economy is weak, so we need more support, so the central bank can cut the rates. That signaling that the stock market that can be a reading that's kind of the signaling the weaker economic activity in the US, weaker economy, weaker GDP. All these data also can pressure again the stock markets. Yeah, maybe at the first it can help to gain some points, but in reality, if we look at the details, if we look into the numbers as a real investor, then we can understand it. No, we cannot trust this economy that much. Why? Because we have weakening signals. So stock markets generally in both scenarios, stock market can get the pressure. So I personally cannot say that the stock market can increase much higher than these levels, especially if S&P 500 fell under 5,200, 5,200, and then if it fell under 5,250, then we can say that new downtrend started and it can continue much further. These are overall data and market reaction. If you have any other question, please write down under this video on Instagram or YouTube. I will try to get back to you as soon as possible. Have a good time. Bye.